Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
My guest today is Eric Meltzer, and this is part one of my conversation with him. Eric is a partner at INBlockchain, China's oldest and largest institutional crypto asset and blockchain fund. To give you a sense of INBlockchain's size and scope, consider that they recently announced a $1.6 billion fund with 30% coming from the Hangzhou local government. Prior to that, they already had a couple billion under management. When people talk about institutional investing, these are the kinds of numbers they're referring to. It's a fascinating interview. I should also mention that while I try not to pick favorites or at least express them here, I can't really help myself. I'm really proud of this content, and I think this episode in particular represents the best of what this podcast aspires to be. In this episode, we discuss 1, Eric's descent down the blockchain rabbit hole after purchasing a few bitcoins from a sketchy dude at a cafe in Soma in 2013. 2, how pitching his blockchain project in Chinese led to a partnership offer from the fund that would later employ him. 3, the recent announcement of INBlockchain's new $1.6 billion fund. 4, co-investing with Binance and Sequoia's recent lawsuit against the exchange. 5, why clear-cut investment theses in the space aren't helpful or don't work. 6, the impact of his proof-of-work newsletter. 7, whether or not we'll see a regulated fund denominated in Bitcoin or Ethereum soon. 8, the impact that rapid appreciation of crypto assets have had on blockchain entrepreneurship. 9, why many of the investors in his fund don't want him to hedge. And 10, why it's impossible to overestimate the power of incentives. As a note of housekeeping, I should mention that if you want to discuss these topics or this podcast episode, feel free to join us on our Telegram group at nomicstelegram.com. Please enjoy my conversation with Eric Meltzer of INBlockchain. Eric, can you tell me a little bit about the origin story of your involvement with crypto asset investing?
I found out about Bitcoin in 2013. Back then, it wasn't as easy to buy Bitcoin as it is now. And so I actually went on local Bitcoins. I was living in San Francisco at the time, and I met some kind of sketchy looking dude at a cafe in Soma and brought some cash and I just, purchased my first Bitcoins that way. After doing that, I kind of got deeper into the scene and I did a lot of reading. So back then, the main place to read about this stuff was Bitcoin Talk. And I think Bitcoin Talk is still kind of an underrated place, but it's where Satoshi would hang out. And reading those posts and, reading Hal Finney's dialogues with Satoshi and kind of seeing a lot of the early altcoins, come onto the scene and then die off was a really interesting experience and really got me into this.
It strikes me that you've, for quite some time now, been following kind of primary source dialogues among makers of blockchains, and that has had an influence on the work you do with proof of work. Is that fair to say? Hey, it's me cutting in from the editor's booth. I just mentioned Eric's newsletter, Proof of Work. It's actually how I found out about him, and I wanted to provide some background. Proof of Work is kind of a weekly public stand-up meeting for some of the best crypto asset projects. It includes tweet storms, Reddit posts, and blog articles from leaders of prominent crypto projects about strategy and future direction. What I appreciate about Eric's newsletter is that he decides to focus on amplifying the voices of technical founders slogging it out in the trenches, instead of the usual longer-form thought leadership think pieces from pundits.
And I think something that's really cool about investing in this stuff is that unlike startups where, almost all of the information is proprietary and you're not able to see very much at all, with public blockchains, almost everything is done out in the open. And so as an investor, your ability to do DD is basically limited only by your own tolerance for doing the work and digging through GitHub issues and everything and your own understanding of the space. If you're happy to do that, and it's something that I enjoy doing, you can get a really good picture of, where a project is and where a project is going just by completely publicly available information, which is, it's really unique.
It's cool that that sort of openness isn't just on the blockchain. It seems to be part of the ethos of the entire community, that these conversations and the making happens in public.
I think that's something that is like correlated to project quality. So like most of the best projects are developed very much out in the open. And you can see that with Bitcoin, where like there's a mailing list and there's an IRC channel and then there's the GitHub repo. And if you kind of watch those three spaces, you have a very full picture of everything that's happening, in Bitcoin development. And it's messy. It's, people yelling at each other and flaming each other and, a lot of what people refer to as incivility. But I think sometimes that lack of civility is actually a good thing. Like, that's just what a really decentralized project looks like. I don't think that's necessarily a bad thing.
It's almost like a feature and not a bug that people are yelling at each other behind computer screens, because if they were in person, maybe they would give a little on something that is potentially really important for the network.
To be a good crypto dev, you need to have a pretty extreme personality. Like, I think being fairly paranoid, being kind of fastidious about things that, you don't really have to care that much about in web development is really important.
For everyone listening, Eric and I actually, this is our second take. So we recorded this once and we had some technical issues. And so Eric is being very gracious by doing this again. But part of the benefit of having spoken earlier is that I actually know a little bit about your origin story, and it involves interesting meetings on boats in other countries. Let's dig back into that a little bit more. So you've bought some Bitcoins in Soma on local Bitcoins. Take us with you further down the rabbit hole that you went down to become subsumed with the space.
After that, I kind of was just like in an amateur way, kind of watching the space, but I wasn't too involved with it. In early 2017, I kind of got more into it. It went from there being almost no projects besides Bitcoin that I thought were interesting to stuff like Ethereum coming up and it looking like there was going to be like an actual ecosystem of interesting stuff popping up around the cryptocurrency space. And so I had a few friends that I would discuss project ideas with. And a friend of mine named Ben Yu, who is a really fascinating dude. He's like a Harvard dropout, someone that is always doing something really interesting. And so we spent a lot of time kind of talking about crypto. And at one point we had this idea that it would be interesting to make like a live streaming platform with a crypto economic basis. And the idea that for that came from, I went to college in China. And so I saw these huge live streaming platforms in China that became, massive businesses. But for the most part, the platforms took these huge cuts and the people that were actually creating the content were able to keep very little. And, there were issues around payment processors. And so the idea that we had was like, it would be cool to do this on the blockchain. And there's some pretty big technical dependencies. Like you had to figure out payment channels and you had to figure out, a way to efficiently do micropayments and a way to make the actual like overall token economy work. But we thought it was a good enough idea to be worth pursuing. And so the two of us wrote this white paper. And then I actually went to China for a trip, like unrelated to the project. And while I was over there, I thought it would be kind of cool to like pitch some investors in China, because I had heard that people over there were interested in this stuff and that there were, some good investors that were investing in crypto. And so I asked a friend of mine if she knew anyone that was, doing investments in this space. And so she introed me to this guy who she said was like the biggest blogger in the crypto space and someone that posted a lot on the Chinese version of Quora. So I said, okay, like it'll be cool to take that meeting. Her position was like, if I meet with this guy and he likes the project, then he can introduce some real investors. So I said, okay. And so I go to this meeting and it's at this like really beautiful co-working space. When I was in college in Beijing was like kind of fairly like rough around the edges. And then by the time I came back, it definitely got like a kind of Silicon Valley vibe. And so I'm at this co-working space, gorgeous co-working space. There's like potted plants everywhere and an espresso bar. I meet with this guy who's actually like the partner of the guy that I was getting introduced to. So this guy's name is Lao Mao. He pulls up in a Porsche. He sits down and I'm like, like I guess blogging is like really lucrative in China. And we start having this talk and it's just really great. Like we really agree on sort of like what projects are worth doing, what projects are stupid. And I think there's definitely some bonding that happens between crypto investors over just like hating on crappy projects. And so at the end of this meeting, he says like he would like to invest personally. And INBlockchain, the fund that I now work for, is interested as well. And that I should come present at this meeting that they're having in Shanghai in a couple weeks. And so that sounded really cool to me. Like I'd never actually been to Shanghai. So I went to college in Beijing. I never went to Shanghai in the entire time that I was there. So I figured it would be a kind of a fun opportunity. And, I told my co-founder and he was like, we'll scrape together the money for the plane tickets because, we're a tiny startup with no budget, but we'll make it happen. It sounds like it's worth it. We get home and we have invitations in our mailbox that say, we'll reimburse your flights in crypto, which we thought was really cool. We've already booked your hotel rooms. You'll be giving a talk at this super fancy event space in Shanghai. And then there's an after party on a boat in the river. So we're okay, what have we gotten ourselves into? And so, yeah, we showed up to this meeting. What it was the portfolio companies of INBlockchain, which included Zcash and IM token and a bunch of really awesome projects. And then also about 100 users, the power users from INBlockchain's exchange at the time, which was called Yunbi. And so it was this really interesting group of people, both Chinese people and then also people from the States and from all over the place. And so we showed up to this meeting and I pitched our project in Chinese. There was this really funny moment where I'm this Jewish white guy giving the talk in Chinese, and my co-founder is a Chinese American guy, but he doesn't speak super good Chinese. And so they have simultaneous interpretation, and he picks up the headphones to get the English interpretation, and all the Chinese people around him look at him what's going on. But it was great. Yeah. And we made a bunch of friends. I became really close with the whole kind of INBlockchain crew and was super excited to have them on board as an investor. And then kind of what ended up happening was I started helping out with a bunch of internal projects at INBlockchain, just with internationalization of some products and with, helping them look at other new investment opportunities. And what it ended up happening is they were just hey, we would really like to just poach you off of this project and have you just come be a partner at the fund. I really had never thought about investing at all prior to that. So I was very committed to working on projects, and I was really excited about what I was working on. So it was kind of a hard decision. Part of what helped me make the decision was someone who I now work super closely with. So my partner on the USD fund that I run now, Carrie Chu, was SLA, the founding partner, is not only a really good business mentor, he's my life mentor. This guy is super wise. And if you join, you're going to learn a ton from him. And at the time I thought that was a little creepy sounding. And I wasn't sure what I was getting myself into. But then I had a couple more meetings with SLA and I was just super impressed with the guy. He's just really a lot of depth of knowledge and a really interesting kind of outlook on the world. And so I figured it would be a bad opportunity to miss. And so I basically, made sure that Stream, our project, was going to be able to successfully complete the fundraising round and bring on some key hires that would be able to do a better job than I was doing even as an ops person. And then I jumped ship from Stream and joined INBlockchain full-time in the summer of 2017.
I think it's really fantastic when operators kind of take a place on the other side of the table and start working for funds. I think it builds trust. I think there's a lot of empathy that comes from that. What would you be doing if blockchain didn't exist? Would you be an entrepreneur? What proclivities did you have coming into this? Were you a developer? Looks like you were a designer. You were definitely a product person.
I think if blockchain didn't exist, I would still be making products. Partially just because that's the only thing I'm good at. And I think a lot of entrepreneurs are entrepreneurs by necessity. No one would ever hire me. I would make a terrible employee. So as a result, I have no choice but to just go do my own thing, which, has worked out well in the past. I think so. A friend of mine asked me, if you weren't doing this, do you think you would be doing traditional VC investing? I'm pretty sure I wouldn't. I mean, so the space is so weird and unique in the investing world because there's this deep technical component. There's a bunch of new technology that no one really knows what to do with. And there's still a lot of research level, interesting innovation happening there. And then on top of that, there's this insane, ultra volatile 24/7 market that's just pure dopamine all day, every day. I think that combination is just uniquely addictive to me and to most of the people that I hang out with in the space.
Let's talk a little bit now about INBlockchain and the partnership and perhaps the role that China plays into this whole story.
So a little bit of background on INBlockchain. We're the oldest crypto fund in China. I'm pretty sure we're the largest, although you never know. We've got a couple $1 billion under management, mostly in Bitcoin. We were also early investors in Zcash and early investors in Saya and BitShares and EOS and a bunch of other projects that ended up being fairly big deals. And so that's kind of been our strategy, is that we try to get in very early on these projects that we see as very promising. And we're not really worried, even if when we join, there's almost nothing. If it's just an idea, as long as the team looks strong, we're happy to be there. That's how we got started. And then going forward, we've actually diversified the fund a little bit. So it's moved from being just purely investment to we also run an exchange wing. So it used to be called Yunbi. And then we launched a new exchange that we invested in called Big One. And we're actually currently developing another exchange product that's going to be sort of more of a platform for other people to build exchanges on and share liquidity. So we're very deeply involved in the exchange space. And then we also have a section that sort of does advisory for, existing companies with interesting businesses that want to integrate a token or integrate some sort of a crypto model into what they're doing. And I would say that actually 90% of that business is just telling people that come to us, don't do a token. A token doesn't make sense for what you're doing. There's 10% that come to us that have really interesting ways of integrating some sort of a decentralized incentive model into what they're working on. So we do that now too. And then I guess very recently, since we last talked, we announced this new fund with the Chinese government that INBlockchain is a co-GP on and that I'm advising, called the Grand Shores Fund. And so that's about $1.6 billion, with 30% of that coming from the Hangzhou local government. The mission there is just to invest in all sorts of interesting blockchain technology. We're kind of working on a lot of stuff, and we see that as a pretty big advantage, because what we've noticed with the space is that there's lots of investors out there. There's not that many great projects, and the really good projects don't need money. They have, people are throwing money at them. And so if you want to be involved with these best projects, you have to be able to bring something to the table beyond just money. And so for us, historically, that's been, we can provide truly useful advice on how to operate one of these projects because we've seen what works and what doesn't. We have an exchange. And so we've been able to help people get their token, some liquidity on an exchange. And I think going forward, that's just going to become more and more important. So a lot of the people that I like to co-invest with are people that have a lot of resources to bring to bear on these projects. And I think that's, if you're an investor in the space and you don't have that, it's going to be tough going for the next couple of years.
I want to talk about this fund with the Chinese government. So the Chinese government is actually in the GP of the fund. Is that correct? Hey, it's me from the editor's booth to explain this question a little bit more. Here, I'm asking if the Chinese government is part of the GP of the fund. GP stands for General Partnership. Funds generally have general partners and limited partners. Limited partners are investors in the funds, and general partners run the fund and take a percentage of the returns they generate for investors, typically 20%. This is called carry. The heart of my question here is whether or not the Chinese government is getting economics in the fund and taking a percentage of carry. Okay, back to Eric.
That's a little complicated. I'm actually probably the wrong person to ask about it. How the Chinese government usually does these funds is that they sort of charge an interest rate on it. So it's a little different than getting actual carry or getting something like that. I believe in this specific fund, though, we actually do have it set up so that they receive a percentage of the ROI of the fund. So they meaningfully are LPs essentially on the fund.
If I were to characterize what I just heard you say, it sounds like INBlockchain is really focused on teams and gets involved really early in token-only projects, or do you also do equity deals as well?
We do absolutely everything. So we do equity, we do tokens, we've invested in training programs. We pretty aggressively have no thesis in the space. We're just very opportunistic, and we go after, what we think are promising teams. And I think that filter has historically worked very well for us. And I think it will continue to work very well, just because there are so few teams that can actually ship meaningful stuff in this space that if you just restrict yourself to teams that you're super excited about, you'll do well. It's funny. I've had friends be man, you really seem to love the founders of the stuff that you invest in. And it's that is our bar. If I don't fall in love with the team when I meet them, then we're probably not going to invest.
Let's dial in on the statement you made about a thesis. So I've heard a lot of funds recently talk about the strength of their thesis, but it feels like after further questioning, there really aren't any intellectually rigorous theses in the space. What is your take on a thesis? Is it a limiting filter? Is it helpful? Is it not helpful? Where do you come down on that?
I think it's not helpful. I think for the most part, it's marketing. And so, for a lot of these new funds, I respect that. They have to go kind of do what I think of as content marketing, where they go and write a bunch of fancy thought pieces about how they think about the space. The problem with those is that they age extremely poorly. And so if you read people's, hot takes about the space from 6 months ago, they already appear almost nonsensical. And I think with a space that moves as fast, that's just going to keep happening. And so it's much more important to just embrace the uncertainty and just try to find the best projects at any given time, rather than have some fancy, overarching conceptual thesis.
I believe you said this last time, there's probably just not enough deal flow in this space to have a thesis. You're going to miss a lot of opportunities. I do think, though, that there is a need for differentiation, and there's a number of dimensions along which a fund can differentiate itself. So it seemed like at first it was all just about exposure to the space, that someone was a trusted party or a trusted partnership. They had the custody thing under control. They had reputable backers. And it was all about, institutional investors that wanted some exposure to Bitcoin or to Ethereum. Now there's a whole bunch of funds. How do you think a fund does go about differentiating now that so many people are offering versions of basic exposure?
I can talk a bit about like some of the funds that I co-invest with a lot, because I've chosen those basically because I really like what they're doing. And I think that they bring a lot of value to the projects that we invest in. I mean, also just a lot of these are just people I like. And it's always fun to like hang out with friends and invest in cool stuff. One of the people that we've started co-investing with is like Binance. The large exchange has their own fund now called Binance Labs. And we co-invested in this project called MobileCoin with them, which was actually their first big investment. And I've been super impressed with the team there. They're extremely smart and they have a deep view of the space. But I think what's cool about, a fund like that is that they're coming from a place that's totally different from your average fund. I mean, so these guys are running this enormous multi-billion-dollar business that's at the core of a lot of these token economies. And so, I mean, besides the obvious benefit of like, they can help you get onto Binance, which is certainly not guaranteed, by the way. It's probably easier for projects that they invest in. Beyond that, and I think perhaps more importantly than that, they've just seen so many projects. They've seen what works. They've seen what doesn't work. And so they're able to provide like really useful guidance, much more than like, just some guy that's into Bitcoin and like found a couple $1 million to go invest. I really like those guys. And I think in general, like funds that are coming out of other large crypto businesses, like Coinbase got a lot of flack for starting a fund. I think Coinbase starting a fund is totally awesome. I think it's a no-brainer and that they should do it. And it seems like it's going very well for them so far. So yeah, I'm really into funds that are spun out of existing big crypto businesses. Another fund I really like is Linda Xie and her partner Jordan have this fund called Scalar Capital. And so they actually do have something that like kind of approaches the thesis, which is just that like privacy coins are super undervalued. And I think that's like simple enough that I'm okay with it. Like it's nothing too like over intellectual or whatever. But what's cool about that is it's allowed them, because they mostly focus on privacy, although they invest in a lot of other stuff too, they've been able to become complete experts in the privacy space. And so they're able to make really, nuanced decisions about what to invest in and how to allocate capital within that space. Funds like that like maybe don't have a complicated thesis, but do limit themselves to some specific niche in order to have really a lot of time to do a deep dive into it is potentially good, especially like if you're a really small fund. So like I believe Scalar right now is 4 people. It might be 5 by now, but it's very small. And I think if you have, limited manpower, it makes sense to limit the kind of stuff that you invest in, and so that you can have like a really deep understanding of the companies you are involved with.
What about methodology, active versus passive management, quantitative trading, maybe taking a venture capital style, momentum and sentiment trading? Do you guys work all those strategies, or are you primarily early stage, buy and hold, going for large returns?
At INB, we are pretty heavy onto the like buy and hold side of things. And we've certainly left a lot of money on the table because of that. At the same time, like the active strategies that some funds pursue, which I think are great, like there's arbitrage and there's all sorts of pretty simple algorithmic strategies that work quite well. They tend to be more suited for smaller sized funds. So like you can't really do ARB on, $2 billion worth of Bitcoin. And so for the large fund, there's a limit to sort of how much we can really get out of trading. And then when you do actively trade, you are exposing yourself to all sorts of risks. So you're exposing yourself to counterparty risk on the exchanges. You're exposing yourself to the risk that you'll just miss time, a big trade and miss a massive run up in Bitcoin. You're exposing yourself, like the difference in the security model between having your coins in cold storage and having your coins even in like a really, really secure hot wallet that's like able to go be traded on exchanges is huge. And so I think for Xiaolai and for Lao Mao, the founding partners, to some degree, like trading just hasn't really felt worth it. That said, for like our smaller fund, we do some active management, like we rebalance a portfolio every so often. And we are, actively finding like we're hiring a trading team right now to get a little bit deeper into that.
It sounds like your edge is probably one of the few categories of edge that I think actually exists, and that is just deep operational experience in the space, running exchanges, working hand in hand with founders that are also, in some cases, LPs in various funds and just running very, very, very deep in the space. And I think there's just not a lot of that out there right now on the investment side of things.
We're really paranoid about losing our edge. And especially Xiaolai, something I really respect is like, he is super unwilling for us to just like rest on our laurels and say, well, we're like the biggest Chinese fund and we'll always be, people will always come to us. And so we do a ton of work to try to like maintain a bunch of really useful resources for founders. And I think, that's the only thing that's going to keep us relevant, because like the space does move so fast, right? That if you just kind of sit around and say, well, we made a bunch of awesome investments, people will come to us. That could be fatal, very quickly.
On the deal side of things, what do you see the founders of these projects really being motivated by? I saw you tweeted out an article about Sequoia suing Binance because of probably the no shop clause in their docs. Sequoia is claiming that they did shop the deal around, even though they didn't take money from either party. So you can't just be Sequoia anymore and, walk into a crypto deal and assume that you're going to get this done. What is making a difference? Does the proof of work newsletter make a difference? Does connections to exchanges? I imagine it's a variety of things for different projects, but how do you see founders, responding to different things that you and competitor funds can offer?
Let me just go back to the Sequoia thing for a second, because I just want to comment on how ridiculously badass that is for Binance. You can think about this a lot of ways, and I've had people disagree with me about my take, but in my opinion, when one of the world's best investors is suing you for an opportunity to invest in your project, that means you're doing something extremely right.
It's me again with some additional background. As I understand it, Binance signed a term sheet with Sequoia. While this doesn't obligate Binance to take a deal from Sequoia, these contracts often have what's known as no-shop clauses, which means that Binance can't pitch to other venture firms while they're locked up. Sequoia appears to be suing Binance not because they took an investment from another firm, because it appears that they have not. Instead, they're suing because Binance allegedly was in talks with other investors. Like Eric said, when the world's best-known investors are suing you, not because you took a deal from someone else, but because you spoke with other firms, you've probably got a pretty great business on your hands.
And in general, even though Binance is, I guess, in some sense, a competitor to us, I'm just really extremely impressed by how they handle things. The ops team is fantastic. Their security is fantastic. They're really just executing on an incredible level. And I think, Sequoia and IDG and all these other guys have noticed that and very badly want a piece of it.
It is pretty incredible. And in my opinion, it comes off a little petty on the part of Sequoia that they're actually going to do this. If you want a reputation as being founder friendly and you're going to sue a company because you didn't get a deal that nobody got in on, that's just absurd.
If you're Sequoia, you can get away with it, I think. I don't know. It's a little weird though, for sure. But so to return to your question about sort of what makes a difference for us in terms of getting deals, I think stuff like proof of work is really useful in just knowing people and actually seeing the deals. So not necessarily, inking the papers, but at least knowing about cool stuff that's happening. And I would say I'm personally fairly lazy. I don't really like going to conferences. People laugh at me when I say this, but I'm fairly antisocial. And so just having a network of founders that are building cool stuff has been really crucial for me in actually seeing a lot of these awesome deals. And then I think what tends to, get our foot in the door and actually get us in these deals is that for most of these projects, they do want someone to be sort of a partner for them in China and help them navigate the community there and find developers and investors and everything over there. And I think we've historically been able to do a really good job with that. And we're doing a lot of work to make sure that we kind of stay on top in that area. And so that's been sort of what ensures that we have allocation in a lot of these projects that we're really excited about.
As a founder myself, I could definitely see there's real opportunity to provide value there, especially given how new the entire space is. It seems like a lot of venture funds, or actually crypto hedge funds, are in a lot of ways decentralized incubators and these networks that kind of pool knowledge across different groups in legal jurisdictions and technologies and technology stacks. It's fun to see innovation just kind of move through the system in a different way than it ever has before.
It's really fun. And I think a lot of times people that are deeply immersed in a space, they miss the coolest parts about it because they're sort of hiding in plain sight. And so one of the coolest parts about crypto is just that it's automatically extremely international. It's very easy. Chinese fund can invest in a US vehicle or a Cayman vehicle or whatever it is just as easily as someone in the US because you're just going to be sending them ETH or Bitcoin or whatever it is. And so the internationalization of the space, just based on that simple fact that like you don't have to convince your bank to do a wire to some weird country and there's no, irritating back and forth about paperwork, has massively internationalized the space. Whereas most of these deals, like, we're in, there's like some Korean funds that are in, there's some Japanese based funds that are in, there's, people in the US. So it's really exciting to me. People have been talking for a long time about like the startup scene becoming more global and less purely focused on Silicon Valley. And I think with crypto, that is, finally happening to some degree, which is pretty cool.
Okay, time out. I'm going to do some native advertising for the Nomics API. This episode of Flippening is sponsored by the Nomics API. The Nomics API offers squeaky clean and normalized primary source trade data offered through fast and modern endpoints. Instead of having to integrate with a bunch of exchange APIs of varying quality, you can get everything through one screaming fast firehose. If you found that you or your developers have to spend too much time cleaning up and maintaining datasets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out at nomics.com. Okay, back to the show. I want to talk about proof of work for a second because it's a really fascinating newsletter. It's how I found out about you, and it's something that I hear a lot of hedge fund managers talk about. So there's the hedge fund managers that do the hedge fund manager, like speaking tour. They all seem to be interacting with you on some level. You're kind of like the hedge fund manager's hedge fund manager, because in a lot of ways, it feels like, and maybe I'm off about this, but it feels like you're kind of the direct link to a lot of different projects and the primary source data from the founders about those projects. What has been the response that you've seen to proof of work?
So proof of work is just really fun for me to put out. Like I literally got the idea when I was in the shower, just because like, I was already kind of doing this anyway. So like for projects that I was excited about or for projects that we were invested in, I would kind of ping the founding teams once or twice a month and just say like, hey, what's going on? What can I help with? What interesting stuff have you guys shipped? It was an easy step from that to just putting it all into a newsletter. And yeah, the reception has been great. Like the readership is not huge. It's like under 10,000 readers, but occasionally I've kind of just looked through who all these people are, and it's like crazy impressive people that are reading it, which is, really humbling for me. And it feels really great to be able to like put something out in front of a bunch of people that I really respect. The impetus behind doing proof of work was also that like I saw this weird like anti-correlation between a good project and a project that was good at like promoting themselves. And so what you'd see is like there's these guys that are shipping amazing stuff, but like they're not very good at promoting it. And then on the other side, you would see people that, in my opinion, are doing basically nothing, but are very good at painting a picture of this supposedly massive market that they're addressing or whatever. And so the idea with proof of work is like, if I can just every week get updates from these guys who are building really awesome stuff, then people can see the progress that's being made in the space. And it can kind of counteract this image that a lot of outsiders have of like, there being all these scams or there not being a lot of like actual interesting progress being made. And I think on that level, it's been very successful. It's been really fun for me. And I think it's been fun for a lot of other people to just watch these projects ship. We're on like issue 19 now. And so if you've been following along from the beginning, you have a very good picture of like which projects ship at a really high level and which projects are a little bit more stagnant. And I think maybe that's why like a lot of hedge fund people read it, is it's just, that's very useful data if you're an investor.
The newsletter kind of reminds me of the quote about the Velvet Underground album. The saying there is that the Velvet Underground album only sold 30,000 copies, but
every single one of them started a band.
Yeah.
It definitely has that feel to me. Like everyone that's reading it is someone that I would be super stoked to be in a room with.
If you don't mind me asking, is that owned by you? Is that owned by INBlockchain? Are they supportive of you doing it? What does the ownership look like for that? Is that a side project? How do you think about that project and the role it plays in your sort of day-to-day job?
It's not incorporated or anything. It's just completely a side project of my own making. One thing that I absolutely love about INBlockchain and why I'll probably never leave is just that like I'm given a huge amount of freedom. And as long as I'm acting in the best interest of the fund at a macro level, which is something that I take very seriously and try to do at all times, there's never any concern about like, oh, is this thing that you're doing owned by us? Or, what's the IP situation here? Like it's all just completely casual. I love that. And that's something that really suits my personality. And so yeah, I have to like absolutely thank Xiaolai and Lamao, the founding partners, for kind of setting up that environment. At the big picture, it's like very good for the fund. But yeah, so like proof of work is just kind of my thing. I've had a bunch of people approach me about like monetizing it. I actually had someone approach me to try to buy it, which I thought was funny, but like I have no intent to do that. And for me, it's just like a really fun way to sort of promote projects that I like. I guess the other funny thing is like people have asked me like, oh, like you're just promoting these projects you invested in, but it's actually like the projects that are on there, I'm invested in a minority of them. The majority of those projects are things that I'm not invested in, but that I just think are really cool.
Having read it and several issues of it, it strikes me that you'd have to read pretty widely or have a pretty sophisticated monitoring system set up to find all the places where people are posting updates, because it really does vary from like Twitter tweet storms to Reddit posts to Hacker News. How do you find all that? And over time, are you finding that founders are just coming to you and just tweeting links at you or sending you links so that you at least know?
Proof of work is 100%. Actually, like again, I'm a very lazy person. And so proof of work is 100% founder and team driven. Every week I get like an email from the teams that are on the newsletter with the updates. And so I don't have to actually do anything. I just, format them and send it out.
That's very cool.
People are always like, oh, it's such a great newsletter. And I'm like, I mean, it is cool. Like I love it, but it's not like some, stroke of creative genius on my part. It's just like putting together some interesting stuff and sending it out.
Let's talk about the future of institutional crypto asset investing. Do you think we're going to see anytime soon a fund that's denominated in BTC or Ethereum, kind of shooting for that post-exposure opportunity set?
I do. In fact, so another person who I think is super brilliant and who's doing a fund now is this guy, Nick Carter, who's at Fidelity.
He's great.
He runs a site called Coinmetrics. Shout out to Coinmetrics. Great site. Nick had this question about like, at what point will it be more profitable to invest in Bitcoin adjacent businesses than just investing in Bitcoin itself? And so historically, that's not been the case, right? Like even Coinbase, which was one of the best venture opportunities of all time, actually underperformed just buying Bitcoin. Not by much, like it's roughly equivalent, but like that's still pretty crazy. And so what you imagine maybe is that like once Bitcoin achieves sort of user saturation and that like everyone that needs Bitcoin has bought some, then the growth is going to smooth out a lot. And at that point, if you had a fund that was denominated in Bitcoin and you went and invested in, businesses that were building cool stuff on top of Bitcoin, you should be able to make some money. And so, yeah, like Nick's question is like, when is that going to happen? And I think we still have a ways to go. I think for now, it's like the underlying tokens are going to be more profitable than the businesses. Although, of course, the risk profile is a little different. I'm not holding my breath for that. I think we've got at least another 5 or 10 years.
Do you think that the accrual of value in the space to tokens has had a negative effect on entrepreneurship? In other words, 10 years ago, if you wanted to become fabulously wealthy, not that that should be your primary motivation for starting a company, it probably would make sense to start a tech startup, right? But I think a lot of people who would do that nowadays are just investing in Bitcoin, and a lot of innovation likely isn't happening, or it's turning, to ICOs where supposedly you can generate money out of thin air. What effect do you think that's had on entrepreneurial drive in the space?
An extremely detrimental effect. So what I think is funny is like there are a few teams out there where if you give them 50 or 100 million bucks, it'll be like pouring fuel on a fire and they'll ship at an incredible speed. And so like a team that comes to mind is like the 0x guys, Will and his team there.
Oh my God.
Those guys are monsters, right? Like if you read their updates every week, it's just ridiculous. They hired this really badass product manager named Tom. And when they were hiring him, I was like, so what's going on this week? And Will's like, oh, we're going to hire this really great product manager so that we can ship more efficiently. And I was like, dude, can you maybe just like not do that? Like our other portfolio companies are going to start looking really bad. So teams like that are really rare, right? Like it's not often that you get teams that have the discipline to get these huge influxes of money and then responsibly spend that money. And so I think, yeah, like what you see often is like, without naming names, there's a lot of these projects where like the founders started the project, raised a bunch of money, and then have done basically nothing for a long time. And they're just kind of coasting. Like it's hard to say whether that's like actual malfeasance or not, like whether there's actually like malicious intent there, but like they just have so much money and they're so comfortable. The craziest part is like the Ethereum or Bitcoin that they're holding keeps going up. And so there just isn't like that huge drive that says, okay, we have to get this done or we're going to run out of burn rate and our company is going to disappear. And so, yeah, like I think when we do look at teams, we try to look for teams that we think will be able to handle a massive influx of money without losing their drive.
I think the real makers have this inherent drive to produce. they do want to be compensated, right? Because they're looking at comps in the market, but they're going to make regardless. And, we've seen this with people like Steve Jobs and other great tech leaders is, the innovation doesn't stop when they become rich because they want to put that dent in the world. And I think that's a pretty rare quality. And just like kind of bear markets wash out the casual investors, I think bull markets kind of wash out the casual entrepreneurs.
It's like a pretty comfortable way of getting washed out, but no, I would agree with that. My mental model of like the kind of founder that we want, and of course, like not everyone's going to be at this level, but like if you look at Elon Musk, it's kind of a cliche, but like he took basically all of his money and dumped it into his most recent companies and, put his own personal fortune very much at risk. And so, founders like that, like obviously we really want to invest. And I think like that, I guess from a risk profile perspective, like I'm someone that has like a pathologically high risk tolerance. And it's pretty funny. Like I'm married. My wife is someone that has a very low risk tolerance. She's like very conservative. She's very careful. Being married to her has been really interesting because it throws my own sort of risk taking behavior into the spotlight. But what I've noticed is like the founders that are most successful in the space tend to be a little bit more on the risk taking side of things. And so what we kind of look for is people that do have that like, outsized risk tolerance, just because in so many ways, what you're going to be working on is risky from like a regulatory perspective, from a tech perspective. We tend to see that as necessary. Like the founders have to be people that are okay with just charging ahead and seeing what happens.
A bit of a detour, but one of the things that I really enjoy about our conversations is just how thoughtful you are. I think there's a lot of people talking their playbook in the space, and the way you talk and sort of work through problems, it reminds me a little bit of Ira Glass or people who I really hear sort of process the deeper question. I know this is kind of a personal question, but why do you think that is? Do you think it's because you have to spend less time raising money from LPs? Is it because you travel less and get to spend more time in the shower, sort of thinking over broader questions? Is it because you spend more time maybe focused on founders than interfacing with other people in the financial space? Were you just born that way? What makes you this way?
That's a real compliment. And I actually, as a kid, I grew up listening to Terry Gross and a lot of public radio. Like I was very much a public radio kid, thanks to my mom. So maybe that style of talking and thinking has rubbed off a little bit. I do think that I'm super lucky to not have to be too much on the fundraising side. That's just like a massive stroke of luck on my part. And so as a result, I do get to focus almost entirely just on investment decisions. And I think that gives me a lot of time to, slow down and think about stuff. What happens with a lot of these deals is people will say, oh, you have like, 4 days to decide whether you guys want to be in on the round. And we'll just be like, okay, we don't want to be in on the round. Because like 4 days is not enough to figure out whether this thing is going to go anywhere. I think taking like a slower, thoughtful approach to these things and, actually looking pretty deeply into what it is someone's going to build is really necessary. It's especially necessary for us, right? Because like, we do typically hold these projects for years and years. And so if you're like a trading fund, you can just trade off of the short-term, enthusiasm around a project. For us, that's not so much an option. And so we have to really long-term believe in what someone's building before we can invest.
I'd love to hear a little bit more about China. You mentioned that you have a high level of risk tolerance. I imagine that there potentially is a lot of personal risk doing something like picking up and moving to China and conducting most of your social life and your academic life in a foreign language and a foreign place, a place that is probably as far as it can be from the United States culture. So it seems like your high level of risk tolerance, it isn't just about capital, it's about lots of other things. What played into your decision to go to China?
I mean, it was just completely impulsive. I was a summer student at UCSF working on like a pretty interesting biology project. And there was the opportunity to be an exchange student to China. And I just took it literally, I think, because my PI, my boss at UCSF told me that the food at this institution that I was going to go to was really delicious. And I was like, cool. Like he was like, yeah, you can get like a delicious bowl of noodles for $2. And I was like, all right, sign me up. Because I hang out with like people with pathologically like stupidly high risk tolerances all day. And I think what I've noticed about us is that, people think of it as like, oh, we're taking like calculated risks and that we're more comfortable with that. But I think that's really not the case. It's just like, I don't really see things as risky that other people think of as insane. And so like, when people have asked me like, well, why did you decide to go to college in China? It's like, well, I don't know. It just like seemed like a fun idea at the time. I wasn't too worried about it. It's hard for me to understand like the risk averse perspective on things. And I think it's likewise maybe hard for people who are like more calculating in their decisions to understand what drives, my decision making.
I definitely can relate to that. People have said a lot of things about Bitcoin investing and the amount of my like kind of personal liquid net worth I put into it. And to me, it just seems so obvious that this is the way the world is going to go. Like literally everything has been digitized, jumped on the back of Moore's law and experienced exponential growth. And so like maybe it's not Bitcoin, but like there's absolutely no reason why this won't happen to money, you know?
I think a lot of times like people that I meet in this space, because it does select so much for people with high risk tolerance, like we're people that really value fun experiences. And so for me, that's been a driving force behind a lot of stuff that I've done where it's just like, well, like if this works out, it's going to be an awesome story. And if it doesn't work out, like I'll figure out something else that will work out. And yeah, like that definitely drove my decision to go to China. It drove my decision to get involved with crypto. And I think like having that actually like as an investor, if you have like people think about like the best alternative to negotiated agreement, right? Like the BATNA. And I think if as an investor, like you have some decent downside protection where you're like, well, if this doesn't work out, I'm not completely screwed. That can be really useful. And that can very much enable you to make big bets that can be fund returners.
Let's talk about incentives a little bit. It's something I believe we reflected on last time, but one of my favorite Charlie Munger quotes, I'm not going to get this perfect, but essentially he said that he's spent much of his life thinking about incentives, and it is almost never the case that as much as he values incentives, that he's like never overvalued them.
He's always underestimating how important incentives are.
Yeah.
I think that's super true.
What do you think are the incentivization levers that exist with crypto projects that you're working with? Do you seek to have an influence on those levers? And what do you see as being the most vital ones?
So crypto, if you think about it, like crypto is all about incentives. If you learn about one thing as an investor, like I feel like getting a deep understanding of how humans respond to incentives might be the most valuable one. And you see that with, token models, obviously. You see that with the incentives for a team. Like if a team, gets a huge windfall profit before they've shipped anything, they're not going to have the incentive to go ship. You see that with fund managers who perhaps are incentivized to overraise because they make a lot of money off of a management fee rather than making money, off of actually delivering results. And so I think basically like I totally agree with Munger that like every time I think, well, maybe the incentives aren't so important this time, completely regretted that.
Do you spend much time thinking about vesting schedules and cliffs and when founder liquidity makes sense?
I don't spend a ton of time thinking about that stuff, but it's just like not negotiable for me. So like that's one of the few things that like would just completely kick me out of a deal is if the founding team is unwilling to have a lockup and a vesting period. Just because, again, that's like a very simple way of aligning their incentives with us long term. And so if they're not willing to do that, there's no possible good reason that a founding team could have for not being locked up. And so that would just be like an instant pass.
What incentives do crypto projects have around working directly with crypto funds, given that a lot of these tokens are publicly tradable? Is it because it results in founder liquidity? I mean, I can imagine folks saying, yeah, we'll talk with you, but if you want to buy our token, just go to a public exchange and pick it up and we'll be grateful, but it really doesn't have a notable impact on the price. How does it affect them?
From a selfish perspective, I probably shouldn't say this. However, I would say for the best projects, if they really wanted to, they could like totally just ignore funds and they could just go launch their thing and it would, get liquidity on exchanges slowly. And then they would be able to liquidate it as they needed to fund the project. I would say that like, if you're a really great project, you're going to be able to make your life a lot easier by just bringing in a couple of top tier funds because, at the very beginning, you'll have money to run the company. So you can have an office. You don't have to work remotely. You can you have the cash up front to go do your thing. And then all the stuff that isn't actually building the project. So everything from helping you hire engineers to helping you get listed on exchanges to helping you find partnerships with other crypto projects. The funds involved will help you do that stuff. The equation works out pretty clearly in favor of taking institutional money if you're a project that can get access to the best funds and that can get a good deal from those funds. It's much less clear to me why anyone takes money from these second and third tier funds because it's they're not really going to bring you that much value add. They're probably going to ask for a sweetheart deal compared to what you'd be able to get on exchange. It's going to become tough times for those funds as founders realize that they're really not bringing much to the table.
I think one of the reasons why traditional VCs don't sell part of their ownership stake in a business earlier is because of, regulation and disclosures and potential negative signaling. Do you find that given that you don't need to disclose when you're selling your position or part of the position in a company, that founders really just don't care given the liquidity of the space? Or do they care?
Some projects have lockups, and so you can't sell. I think it's not great, right? Like, we had a little bit of back and forth debate on like, if we invest in a project and it goes up, say 100x, should we sell, 1/100th of our stake just to make back our initial investment? And our conclusion was that in our case, we probably shouldn't, because so like the fund that I run within INBlockchain is focusing on early stage startups in the space. And our LPs are all people who already have a decent amount of money and are purely invested in our thing for access to good deal flow and for exposure to like these sort of black swan type of investment opportunities. And so, my initial reaction was like, well, it's like kind of irresponsible to not like at least ensure that I can return the fund by cashing out a tiny bit. And then from talking to some of our LPs, they were like, nope, don't do it. Like, we just want max exposure to this stuff. And it doesn't really make a difference to us if you have that tiny little bit of risk management or not. And so I think like at the end of the day, for the most part, we're really like pretty adamant about just being long-term holders of this stuff. And it's fairly unusual that we would sell any part of our stake before we're ready to, exit the position.
So your LPs are like, we're not doing this to be safe. Don't worry about hedging.
Which honestly, like in retrospect, that should have been obvious to me, right? Like no one's investing in like an early stage blockchain fund with the expectation of like, having a carefully risk managed portfolio. Like we're probably the absolute tip of the spear in terms of like the most high risk, high reward part of their portfolio. And so it makes sense to behave as such.
Given your risk tolerance and the conversation that we had about incentives, can you tell us a little bit about your own investment in your own fund? I believe you mentioned that you were pretty heavily invested in the fund that you're managing.
I think there's like some stupid regulatory stuff about like what I'm specifically allowed to talk about and not allowed to talk about our fund. I'm deeply invested in the fund, and so are the other GPs. And I guess I would be fairly skeptical about any fund where that isn't the case, just because it comes back to incentives, right? There's like no good reason for the GPs to not be invested with their own money.
I was speaking with a VC who's involved in vertical SaaS, and that's a pretty, I think, mature space right now. He said that in his early days, he used to spend a lot of time helping portfolio companies and would get involved in all kinds of things. And his thought now is that after a lot of reflection, he realized that he spent the greatest amount of time with the companies that were likely not going to be successful, and he spent the least amount of the time with the companies that were crushing it. After doing some data analysis, he realized that it literally made no difference to his returns and outcomes if he was involved or not. And so now his position is, this is a money-only deal. Here's my business card. It's got my phone number on it. You can leave a message. I probably won't call you back. This is what's happening. Do you think that only works in mature markets? And does that type of thinking, does that work in crypto?
I respect that guy for saying that. I think there is definitely some sort of, you have to be careful about like adverse selection, where the companies that like want your time the most are maybe not the ones that are the most successful, and the ones that are just killing it like almost don't need your help. Like I think this space is sort of early enough and is nascent enough that like you actually can be pretty useful to your portfolio companies. Maybe I'm just like comforting myself here, and that if I actually asked our invested companies, they would just be like, you're not that helpful. I think we've done some pretty useful stuff for them. Sometimes just at the level of like brokering important deals, where like they need to make a deal with someone in China that like doesn't know who the hell they are, but they do know who we are. And so just being able to be like a trusted counterparty in some of these situations, I think is quite useful for our companies. I don't know, like I really respect that guy's take. I could see this space eventually getting there. And I do think like there's a lot of kind of BS and self-delusion about like how important post-investment help really is. There's a lot of VCs that make a big deal of what they supposedly do. At the end of the day, how truly useful it is, who knows? I think really like there's a few things that a crypto investor can do to help their companies. And like, other than that, nothing they do is that useful, right? So like you can be a sounding board for ideas that they want to try out, just because like probably a lot of the things they're thinking of trying, like, token distribution strategies or whatever it is, you've seen other companies either succeed or fail at. And so you can very quickly just tell them like, that's not going to work or that is going to work. You can make important connections within the ecosystem. So like a lot of times I think people like really misunderstand how exchanges look at listing tokens, right? So like the public perception, I think, is that exchanges are just super greedy. They want to like take big listing fees and they'll list anyone. In point of fact, like most exchanges, the first thing they think about is like safety. So like they don't want to list any tokens that have like issues with their wallet or that are going to cause some big safety problems for the exchanges, because that's like massively not worth it from their perspective. And then the other thing they want is like, if they're going to list your token, they want to make sure that you actually have a really active community of people that will be trading that token and providing volume, because that's their business model. And so I think like being able to make the connections to these exchanges for our portfolio companies and to give them a better understanding of like what the exchange's actual incentives are has been quite useful. And I guess the last thing I would say is that like we do try to help our portfolio companies with hiring. And I think like with proof of work, I've been able to do that quite a bit more, because we have this like proof of work common app where if you want to work in the blockchain space, you can just like fill out this one form, and then a whole bunch of portfolio companies plus a bunch of companies that I just think are cool will see your application. And, since hiring typically is like the biggest struggle for all these companies, especially hiring engineers, but I would say also hiring like designers is really tough right now. And so, to the extent that we can help with that, we always do so.
I can completely see that both on the dev side and the hiring side. It's getting access to real blockchain talent is pretty difficult. And then on the biz dev side, it seems like there aren't like, really advanced trust structures in place, and everyone's so busy trying to scale and not let the wheels fall off the bus that just getting a hold of anyone who can make a real decision at another company is pretty hard to do if you don't have an intro, and the space is so new that warm intros are hard to come by. I can absolutely see how those dynamics would affect the value add that you bring.
We try to be very cautious about like who we do recommend to exchanges. And from a personal level, like I try to be really cautious about what deals I recommend to other funds, just because like what I've noticed is there's a lot of funds that actually have a pretty good reputation, but like when they send me a deal, it doesn't really mean anything to me. Like the fact that they're investing doesn't make me think it's definitely going to be a good project. Whereas there's a very small number of funds where I'm like, you guys have never sent me anything that wasn't just fire. And I try really hard to be in that category where like, if I'm going to share a deal with other funds, it's got to be something that I'm investing hardcore in this round and that I really believe in. That's another form of value add for the portfolio companies where like, if we invest in only stuff that we really love, then we can very happily go to all of our friends and say, you guys should invest in this stuff too. And that results in these funding rounds that close very quickly, which is important for the projects.
Yeah, no founder wants to spend the majority of their time fundraising when they can go to one place that can syndicate something really, really quickly and get it done. So that concludes part 1 of this interview with Eric. Next week, we'll air part 2. Part 2 is almost as long as today's episode and just as good. In this forthcoming episode, we'll discuss some of Eric's favorite token projects and Eric's favorite thought leaders and resources. We'll also play a lightning round game of overrated, underrated, and have a conversation about how one might bootstrap a crypto nation state from scratch. It's a fascinating conversation. See you next week. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.